Hello and welcome to Moneycontrol. I'm Kaizad Adajania, and I have with me over here Jonathan Curtis, who is the Portfolio Manager of Technology at Franklin Technology Funds. Jonathan, hi, welcome to Moneycontrol. Can you assess, or rather, can you tell our readers as to why the tech stocks have been performing so poorly in the past 1 year, especially now that they had performed so well during the COVID times?
Yeah.
What suddenly went wrong?
So two things have happened, and I'll take it back just a little bit before the beginning of this past year. Essentially, going into COVID, we quickly realized that technology was going to be the antidote prior to us actually having a vaccine available to help us get through COVID. Consumers quickly realized that they needed to digitize their own lives, their own processes quickly. Schools figured out that they needed to educate students from home, and businesses figured out very quickly that they needed to send their employees home and have digital relationships with their employees and their customers. And it drove tremendous demand in the tech space. Now, the real question is how much of that demand is resilient and how much of that demand is more cyclical. On the B2C, the business to consumer side of that demand curve, we've learned that some of those trends were much more cyclical, and that explains why we're seeing some of the weakening in demand trends as the world has reopened. We're streaming less media, we're spending less time on social media, we're not riding our virtual bikes at home as much anymore. We've re-engaged in the physical world. In the enterprise side of the equation, enterprises learned a ton during COVID and found that technology could be quite useful for driving greater productivity. And what we're seeing happening now for those companies is they are investing more in their own digital journeys and extending technology to new parts of their business. So it's part of the weakness that we have seen has been primarily on the B2C side of technology, and as we get through these tough comps of reopening. The other element that has been driving the weakness is about a year ago, it became evident that inflation was going to be running hotter than central banks wanted. And their one tool to address the problem is to raise rates and try and slow the economy. And as they raise short-term rates, that makes duration assets like technology companies that are growth oriented and will generate a lot of their cash flow out in the future as they scale, that made them less attractive on the margin. So investors sold their technology holdings or reduced their positions there, and they bought more short duration type of assets, and that's caused a lot of pressure. So you had two dynamics: rolling over of some of the COVID trends on the consumer side of things, and then a higher cost of capital, which ultimately compressed multiples and drove negative performance from many of the names.
So, as a technology fund manager, when you pick stocks, how big is the risk of picking stocks, let's say, coming out of COVID? I mean, what are the key lessons that, you may have learned as to, how you should see the longevity of the technologies of the underlying company so that you don't have to reshuffle your portfolios?
So certainly we were very cognizant through COVID of which of those names, which of those companies were temporary beneficiaries or would be bringing forward all of their growth into the COVID period and then would stop growing post-COVID or even turn negative. And as we saw, some of these companies spike or saw some of their fundamentals spike and peak, we quickly got those out of the portfolio. But there are many businesses that we believe have been permanently accelerated as a result of COVID. A lot of the B2B businesses. And so we've kept them in the portfolio. And when investors have been selling them down, not understanding the durability of the growth, we've been adding to those names because we think that the growth trends there are going to continue. So, but yes, we have been very, very cognizant of those companies that had a short-term blip or pulled all their growth forward into the COVID years, and then we'll be left with the inability to grow thereafter.
When Indian investors invest abroad in foreign securities, most of their investments tend to go into US markets because obviously that's the most tracked markets globally as far as Indian investors are concerned. And a large chunk of that money ends up with the tech stocks, and the term goes as FAANG stocks or FAANG plus stocks. But as a technology fund manager and as a tech expert yourself, do you think that there are enough opportunities outside FAANG and FAANG plus that investors must take a look at and not just get swayed by those
The FAANG companies are very attractive companies. They've got good growth prospects on their own, highly profitable, very high quality businesses. But the tech sector is dramatically bigger than just the FAANG companies. And what's remarkable to me is the extent to which investors repeat this mistake. This is not just unique to Indian investors. Most retail investors think that the tech sector is just the FAANG companies. Maybe they include Microsoft. Maybe they're aware of the Chinese tech companies. And what I think really makes a lot of sense is for investors to work with an active manager who is doing the work on these smaller and mid-cap companies that they don't know about, who can be the next emerging leaders, the next Microsofts, the next Facebooks. That's where we spend our time. Now, certainly we own some of those FAANG names, but we are much more overweight small and mid-cap companies in our portfolio.
So give us some examples of some emerging technologies throughout the world that you are looking at.
Sure. So
over the next 10 years.
Our fund is built around this enormous opportunity of digital transformation, and underneath that big theme are 10 sub-themes where we are focused. 2 of them are particularly interesting to us: cloud computing, and there's some of the big players in cloud computing: Microsoft with its Azure business, Amazon with its AWS business. But there are a number of really exciting niche providers in the cloud computing market that we are also investors in. Names like a Confluent that helps with processing of streaming data as a cloud service, HashiCorp that helps to manage cloud assets, or even Snowflake, which is gotten to be a fairly big company that helps companies understand and process their data in a cloud model. The other big theme that we're very excited about is artificial intelligence and machine learning. We are finally at a point where we are able to quite literally create human capital out of data, software, and semiconductors and compute. And with that, we are starting to see these very powerful artificial intelligence and machine learning models being paired up with software developers, with creatives, with knowledge workers to make them dramatically more productive. And that market, I don't even know how to size it, but it is some derivative of the size of the total human capital market. So it's probably very, very large. And we are also invested in that through names like a Databricks or a Snowflake or an NVIDIA, key beneficiaries of artificial intelligence.
Okay. Last couple of questions, Jonathan. What about the Chinese markets and the Chinese IT industry? I mean, there's a lot of regulatory risks over there, but of course it's a big market you can't ignore. So how do you balance it?
Yeah, listen, I have a number of great businesses that I can own in other parts of the world. Alibaba, Tencent, Baidu, they are fine businesses. Their valuations certainly look attractive. The problem that I have as a fund manager in the West is I don't know how to price the risk of the Chinese government. And there's a phrase, don't fight the Fed. Well, I'm going to add a new one: don't fight the Chinese government. The Chinese government doesn't appear to love these digital transformation techniques. They don't seem to want these businesses to have open-ended growth and profitability opportunities. As equity investors, I'm not even clear what I own, because I really don't own the equity. I own a promise to get financial returns from the company, but through these odd channels. And then the Chinese government plays a role in capital allocation decisions for these companies. So all of that is risk that I don't know how to quantify and understand. And there's so many great businesses that I think investors do not appreciate that aren't subject to those same types of risks. I'd rather just go own those.
Okay. And Jonathan, last question. For an investor investing in mutual funds and equities, how much percentage should go in thematic funds or even technology funds?
Listen, I am a firm believer that technology is a tremendous secular growth opportunity that is going to grow for years and years and years and years, because it is always about driving productivity. And in the sector now, these companies have figured out how to be very high quality businesses, platform businesses, businesses with high margins. They have strong balance sheets. So ultimately, investors should own some technology in their portfolios, period, full stop. The real question is, of course, how much should they own? And that is a question I can't answer. That answer is something that your readers and my clients need to figure out in combination with their financial advisors. And ultimately, what is their risk tolerance? When do they need the capital back? One of the dynamics of the technology space is that there's constant innovation and disruption happening. And so that makes the sector inherently more volatile. There's also duration risk, and that makes the sector more volatile. So again, this is something that needs to be figured out with.
But a minimum holding period for that, since you mentioned duration risk, a minimum holding period in a technology fund or in any kind of a sector fund.
Again, I think every investor should have some exposure to high quality growth businesses. And they should be prepared to hold them for as long as possible. They should be core parts of their holdings. The question is how much, and that is something that only you, when you talk with your financial advisor, can figure out based on your risk tolerance and when you need the capital back.
Okay. Thank you so much, Jonathan, for
Great.
coming to us. Thank you so much, listeners. For more news, views, and updates, please log on to moneycontrol.com.